The top business stories live from the Sky News City studio. Price rises lift profits at Unilever, but the groceries giant said food inflation has now peaked. A surprising increase in consumer confidence in the face of cost of living concerns. Plus, Virgin Media O2 confirms it plans to shed 2,000 jobs by the end of the year. Good morning, this is Business Live with me, Ian King. The groceries giant Unilever this morning became the latest player in the sector to declare that food inflation has peaked. But the company behind Marmite, Magnum ice cream, Dove soap and Hellmann's mayonnaise said it was still having to raise its prices to reflect higher costs of commodities such as oil and grain. Well, Unilever was reporting a net profit of €3.9 billion for the first 6 months of the year. That was up 20.7% on the same period last year. That came on the back of a 9.1% rise in underlying sales growth during the period, all of which came from rising prices. Unilever's sales volumes fell by 0.2%. The figures, news of which sent the shares up 5%, are the first reported under Unilever's new chief executive, Heinz Schumacher. Well, joining me now is Charlie Huggins. He's manager of the Quality Shares portfolio at the investment service Wealth Club. Charlie, very good morning to you. I mean, obviously, the Competition and Markets Authority is sniffing around the food supply chain now. Unilever's operating margin there is 18%, way ahead of the supermarkets. Is that likely to land them in a bit of hot water, do you think?
I mean, yes, Unilever's margins are a lot higher than the grocery chains. You would sort of expect that, given their business. You know, they do have some very strong brands, and so you would expect them to have higher margins than those other players. I would say that their margins have actually come down quite a long way since pre-pandemic levels. So although Unilever have put through quite a lot of price increases, as we're seeing with this recent statement, they haven't actually covered all of the cost increases that they've seen, because those price increases have been absolutely extraordinary. We've seen such a high level of inflation. So yes, the prices have gone up, but not enough to prevent margins falling.
And very interestingly, in Europe in particular, consumers in food look as though they've been pushing back against some of these price increases. I mean, the volume drop-off in food in Europe was pretty startling.
Europe is really where they're seeing the most weakness. Volumes in Europe were down around 10% in the second quarter, which is a very steep decline. I can't remember Unilever ever seeing that level of volume decline. And that suggests that some consumers are voting with their feet. Some brands within Unilever's portfolio in Europe are coming under pressure. We're seeing down trading. We're seeing the discounters, Aldi and Lidl and the like, doing very well. So that is all pressuring volumes in Unilever's European business.
Operating margins in ice cream were down from 16% to 15%. I mean, that will strike some people as quite surprising, given the hot weather we had, particularly in June.
Yeah, I mean, ice cream sales out of home have been quite good for Unilever, but the ice cream sales through stores have been less positive. And the group did comment that it has seen some down trading. So in other words, people going to some cheaper brands within ice cream, and presumably that is because of the pressure that the consumer has been under. So some pressures within Unilever's ice cream business related to down trading, especially in Europe.
I mean, this is the interesting thing for me, Charlie. Now, if you look at their beauty and health and well-being lines, the operating margins there are substantially higher. They don't seem to have had the pushback from customers where they've raised prices. That is clearly where all the growth is coming from for this business, really.
I think that's their priority, is the beauty, the prestige beauty part of the portfolio. It does seem more resilient. I think consumers generally are less willing to switch in that category, whereas in the food part of the business and nutrition, we have seen some consumers down trade. So you know, that beauty part of the business does seem to be more protected, and there's a more brand loyalty in that part of the portfolio. So I think the new CEO at Unilever, Heinz Schumacher, will very much prioritise that part of the portfolio.
Well, that's an interesting point. And also, I mean, there's been a lot of talk in the recent past about potentially Unilever demerging food and ice cream. Do these results make the arguments for that stronger?
They probably do, because we've seen those parts of the business perform weakest this quarter. I think the new CEO is going to take a very close look over the next few months and just think which of the key brands does he want to prioritise for investment. He did comment that the biggest brands, so the top 14 brands, which make up over 1 billion of sales, they will be a key priority. He wants to invest more behind those brands. And the top 30 brands make up 3/4 of Unilever's sales. So it's the smaller, more regional and local brands, the tail of Unilever's portfolio, I think, that could be on the chopping block. I think it's unlikely that they'll be selling off any of their bigger brands.
Does life get easier for this company, Charlie, now that inflation appears to have peaked in some commodity products?
I think so. I think the second half will be easier for Unilever. They've commented that inflation has peaked. They've had to contend with a huge level of cost increase, unprecedented really over the last couple of years. That does now seem to be easing significantly. That should help them to drive higher volumes because they won't be so reliant on increasing prices, and operating margins and profit margins should hopefully start moving in the right direction.
All right, Charlie, got to leave it there. Appreciate you joining me today. Thank you.
Thank you.
Now, staying with the cost of living now, and there is evidence this morning that UK consumers are starting to feel more confident about their spending ability. The latest consumer sentiment survey from the accounting and consultancy giant PwC reports that consumer confidence is at its highest level for 18 months. It says there's been an improvement in sentiment across all demographic groups since the spring. Well, joining me now is Lisa Hooker. She's consumer markets leader at PwC. Lisa, good to see you this morning. Before we get too excited, we should say sentiment's up from -25 to -13. I mean, there are still more pessimists out there than optimists.
The only thing I would say, as a nation, we are always slightly pessimistic, and we've been tracking this now since 2008, and it's actually quite near to what is the long-term normal. So even though it might look negative at -13, it's actually pretty decent.
Oh, we're a miserable lot, we Brits, aren't we? I mean, what do you put this recovery down to?
I think there's many factors. As you said, inflation is now coming down. Employment levels are holding up. We've seen 7% increase in incomes, and we've seen inflation linked to both pensions and benefits. And there's also quite a group of people, the younger and the older, who are actually quite confident in their finances.
Yeah, why is that? We've talked about this before.
Well, it's funny because the younger generation are often at home, don't have families, first job, and are feeling quite confident and actually only want to live once and really do want to go out, spend and prioritise their health and well-being and fashion. While the older generation aren't seeing the same impacts from interest rates because often they've got savings and them getting money on their savings. Their pension can sometimes be linked to inflation, and so they're feeling more confident. And I think post-COVID, they just want to go out and enjoy themselves.
Yeah. Well, now, what about 55 to 64-year-olds? I mean, these are consistently the least optimistic people that you survey.
I think that age group is still very much funding the family, whether it's teenage children, children going to university, or even having restrictions on working hours because they're looking after elderly parents. So I think that squeezed middle does get impacted the most by what we're seeing and the inflation factors.
So what are all the implications of all this for consumer-facing businesses?
Well, I think it is finely balanced, and there are reasons to be fearful, you know, the full impact of interest rates coming forward, slowing global growth. But I think there's also reasons to be cheerful in the terms of as inflation goes down, you'll start to see incomes go above inflation. And also consumers are really prioritising special events, and they want to trade down but also splurge. So it's really for these companies to identify who's their consumer, who's spending and on what. And I think there are opportunities for our consumer companies.
Is this what you would have expected to have seen at this point in the cycle? I mean, for a lot of people, the mortgage interest rate increases haven't really bitten them yet. I mean, that's all to come.
Yeah, I think the consumer's been far more resilient than we expected. I will say that although headline sales are up, volumes are down because people are being squeezed. But the thing about mortgages, only a third of people do have mortgages. And the flip side is those with savings, and COVID savings make interest now, better interest on their money. So the interest rates aren't the biggest factor. When we ask consumers, over 80% said inflation is the big factor that worries them. And it's more like 30% talk about interest rates worrying them.
And what about the different socio-economic groups? What have you found there?
Well, you always find that obviously the more affluent are more positive and the less affluent are more negative. The good thing about this survey is actually everybody at all age groups has improved, but you do see the less affluent are struggling the most in terms of having money left at the end of the month and sometimes missing bills. So that is the group that are probably having to save, cut back and trade out the most in terms of our consumer.
And is there much of a difference between men and women and how they view the world?
Actually, men are always more positive than women in terms of consumer sentiment, and it's always been the case. Historically, people have said, well, maybe the women do more of the budgeting in the home and are more aware of the cost of food, but that has continued throughout the time we've been doing the survey.
That's absolutely fascinating. And you touched on employment levels there. I mean, there are an awful lot of vacancies in the economy. Are you picking up on the ability of people to switch jobs very easily and how that impacts their mood?
Well, I think we have seen a slight easing in terms of availability of labour. And if you look at our sector, like hospitality, has been really struggling. I've even had to cut down the hours they're open to deal with some labour shortages. But I think as effectively labour market eases and some measures are put in place, we are seeing it a little bit easier to get people. And there is a willingness, as the cost of living crisis hits, for people to be to do different jobs and maybe take on some more hours.
All right, Lisa, got to leave it there. Good to see you today. Thank you.
Thank you.
Some other business news stories for you now. And the broadband and mobile operator Virgin Media O2 has confirmed that it's looking to shed 2,000 jobs by the end of the year. The company, which last month shed 800 jobs, was reportedly handing out more redundancy notices yesterday. It currently has a workforce of around 17,000, but is looking to cut costs as it grapples with debts of just over £20 billion. Well, the news came as Virgin Media O2 reported underlying earnings of £1.016 billion for the 3 months to the end of June. That was up 4.6% on the same period a year ago. The energy regulator Ofgem has fined the energy generator SSE £9.78 million for breach of its generation licence. Ofgem said that SSE had secured excessive payments from the electricity system operator, that's the arm of the national grid that ensures electricity supply meets demand. The breach was in May 2020 when SSE Generation raised the prices charged for energy from its Foyers pumped storage power station in northern Scotland. Spotify is raising the price of its advert-free premium service in more than 50 countries, including the United States, the UK and Ireland. The music streaming company, which has more than 200 million premium subscribers, said the move will result in a £1 a month increase for UK-based users. Well, stocks in the Asia-Pacific region enjoyed a solid session overnight, with Hong Kong and Shanghai rising by 4% and 2% respectively after China's Politburo promised to step up stimulus for the economy. Well, that's been followed by gains this morning in Europe. Only the IBEX in Madrid in negative territory, again really related to uncertainty following the Spanish general election at the weekend. Talking points this morning include Bayer, the German pesticides and drugs giant, is up by some 1.5% right now in Frankfurt, and that is despite the fact that it cut its full-year earnings outlook. Here in London, the FTSE 100 also in positive territory. Not much in it, to be honest. It's only up 0.1%. The miners helping out there. The leading blue-chip gainer right now is the specialty chemicals group Croda, which is ahead by some 4%, despite an 80% drop in half-year pre-tax profits that had already been signalled to the market. Unilever also among the leading. In fact, look at that. Unilever now top of the gainers board, up nearly 4.75%, as parts of that results statement were better than expected. To the downside, Compass is off by some 4.5%. The trading update today from the world's biggest contract caterer was in line with expectations, and I think investors may have been looking for a little bit better than that. Outside the FTSE, stacks of company results to digest. The recruitment firm S3 is up 3% on its update, but the private equity firm Bridgepoint is down by some 5% as it reported a 28% drop in core profits at the half-year stage. On the foreign exchange markets, you had a bit of Scott the Antarctic there, but here come the currencies. The pound up very, very marginally against the US dollar. It's been drifting ever since the inflation numbers last week. Sterling also up by 0.25% right now against the euro. The single currency off by just under 1/6% against the greenback. As for the oil price, well, that rallied hard last night to hit its highest level since the end of April. It's consolidated those gains this morning. A barrel of Brent crude will currently set you back $82.82 a barrel. That is up a little under over 1/10%. Well, joining me this morning is Alicia Flory, consumer analyst at Investec. Alicia, great to see you again, and what a great day to have you on the programme, what with Unilever reporting. I mean, the shares are up. What was your thinking behind that?
Well, I think it makes a lot of sense. I think this was a really strong, broad-based delivery by the company this morning. You had volumes better than the market expected. You had margins much better than the market expected. That was really driven by home care, where gross margins were up, and in nutrition, where although they weren't able to pass through all the input cost inflation, they were able to cut overheads such that margins were able to expand in that part of the business. And of course, EPS 8% ahead is very strong and leading to the 4% plus rise that we're seeing this morning in the share price.
Yeah, it's quite rare to see such a big stock moving like that. Do you think expectations were just so downplayed prior to coming into these results?
Well, I think Unilever has had a number of challenges over the last few years, and the big organizational change that was put in place last year was expected to make improvements, but I don't think anyone expected them to make improvements at this particular pace. So it has been better, faster than expected.
Now, the new CEO, of course, he's promising a strategic update with the Q3 results in October. Do you think he's going to be a radical guy that breaks up the company?
I don't think so. I think it will be more an evolution of the strategy and perhaps fixing areas that possibly had been overlooked or enough attention hadn't been paid to in the past. So today on the analyst call, he talked about the need to enhance the performance-based culture that perhaps indicates that there may be some changes to managers' incentives.
Yes, it's all about execution, yeah.
Yeah.
Now, your favourite, we should say, in the sector is Reckitt, who report tomorrow. What are you expecting to see there?
Yes, that's right. I do have a buy on Unilever, of course, as well, but Reckitt within household and personal care is my preferred name. I think they will have strong results tomorrow. Again, expectations reasonably low there. And of course, all the consumer trends that have been helping Unilever will also help Reckitt and others. We like Reckitt because it's proved that it's quite an agile business. It's handled a huge amount of disruption to its business over the past few years and delivered very well in the face of all of that COVID, supply chains, competitor disruptions, needing to ramp up infant formula very quickly, all kinds of business disruptions. And they've also got a very clear medium-term strategy. They've got advantaged categories. Unilever, I think there's still some question marks about what is the best strategy there, whereas Reckitt, we know where they're headed. It's a lot clearer. Yeah.
Are you at all concerned about this CMA investigation into the wider food supply chain in this country? I mean, on the face of it, Unilever's margins in nutrition are way above those of the grocery multiples.
Yes, so I think it's important to note that there's been no suggestion of any wrongdoing by any of the suppliers, but the CMA is looking into 10 different product categories and the suppliers within those product categories. The one that will affect Unilever is mayonnaise, is one of the 10. And in that instance, they'll be looking at, pricing policies and whether that has been hurting the consumer unfairly. We just don't know yet. We'll have to wait and see what they find. But I will point out that the UK is only 4% of Unilever's sales, and mayonnaise would be a fraction within that.
Yeah, I mean, that's the thing that people forget. This is an absolutely gigantic global company that makes, well, it's only 20% of its sales are in Europe now. Most of it's in Asia-Pacific and the Americas.
Yes, absolutely. And Reckitt won't have any real impact from those 10 categories.
No, absolutely. Alicia, great to see you again this morning. Thanks very much for joining, and on such a busy day as well. We do appreciate it. Thank you. Still to come here on Business Live, a worrying rise in profit warnings from UK-listed companies. Stay with us.
Brilliant colours in red, dark light. Revive the shine, treatment smooth and strengthens, yeah, you heard that right. Just mix and dye, treat and shine. With Clairol, I'm ready to colourfy.
Nice and easy. It's the natural look I love.
Clairol, it's so me.
He loves you so much. Every day he showers you with gifts. Warm, yellow gifts. Love is stronger than dog week, so is plenty. Now 50% longer and with flexi-size sheets. Choose how much you use. One sheet does plenty.
I'm rough and ready for my dinner.
I'm an all-rounder. You name it, I can do it.
Other dogs stay. I namaste.
Frisbee catching.
I've tried all types of food, but Tails.com makes food just for me.
Tail chasing.
It's like having my own personal chef.
I have superpowers.
I don't play favourites. OK, lamb, that's my favourite.
I never leave my toy. Never. Wait, what's that? Dinner time!
Every dog is different. Come to Tails.com and tell us about yours. Right now, get 50% off your first box.
Enjoy even bigger savings in the Hillary Summer Sale with up to 50% off selected blinds, curtains and shutters. Plus, save an extra 10% off when you book by the 31st of July. All with measuring and fitting included. Book your free appointment today. Call 0800 916 1010 or visit hillarys.co.uk. Extra 10% off ends soon.
Most health and life insurance just stands there, doing absolutely nothing. Unless the worst happens.
Oh, this is my kind of speed.
Vitality is different. Our insurance is as active as you are. Not just protecting you, but rewarding you when you get active. With everything from weekly coffees to half-price gym membership. And right now, you'll even get up to 2 months cashback on your premiums.
How do you think they're going to react when we tell them they can't leave?
This place, it isn't what you think.
If you're still outside when the sun goes down, you and everyone else are going to die.
Hi.
What if all this was designed just to see how we react?
This ain't real.
You said that you were going to find answers.
Brand new series, From. All episodes available now on Sky Sci-Fi.
Make sense of the markets. Interactive Investor, sponsor of the Sky News Financial Reports. Interactive Investor, sponsor of the Sky News Financial Reports.
Welcome back. Bit of breaking news to bring you, which concerns Jaguar Land Rover, obviously the UK's biggest car maker, in the news last week because it announced a major investment in a UK car battery facility with support from the UK government. Well, its parent company, which is Tata Motors, the Indian company, has published its results for the 3 months to the end of June today. They came in at 32.03 billion Indian rupees. That's around 391 million US dollars. And that compared with a loss in the same quarter last year of 50.07 billion rupees. And the majority of that is down to Jaguar Land Rover, which normally accounts for around 2/3 of the profits at Tata Motors and 2/3 of sales. Well, it's actually accounted for some 70% of sales during the latest quarter. So some good news out of Jaguar Land Rover. Now, UK-listed companies issued 66 profit warnings during the 3 months to the end of June. That was the highest for the quarter since the early stages of the pandemic 3 years ago. EY Parthenon, which compiled the figures, said warnings have now risen year on year for 7 consecutive quarters. That was the longest run of increases since the 2008 global financial crisis. Well, joining me now is Joe Robinson, EY Parthenon partner and UK and Ireland turnaround and restructuring strategy leader. Joe, good to see you this morning. What do you put this down to?
Yeah, good morning. I mean, there's a variety of reasons behind that companies are quoting at the moment. You know, we're seeing nearly 1 in 5 UK listed companies have issued a profit warning in the last 12 months. And some of the reasons behind this is, firstly, this quarter we're seeing much more quoted around a more expensive borrowing environment. So that has an impact on the balance sheet as well as cash. It makes refinancing more expensive and also, a big effect on sectors where credit availability. Secondly, it's around continued economic uncertainty. We've seen a really slow build of pressure with one issue after another. So that's taking its toll on confidence. And then we're starting to see, thirdly, these challenges are spreading. Previously, we'd seen majority of profit warnings hitting the smaller companies, but this time we're seeing that move and spreading to more mid-sized firms in this particular quarter. And that's the highest proportion of warnings in this group since 2019.
Obviously, Joe, by definition, a profits warning is because expectations for a company's profits are out of kilter. Sometimes that's because a business has just been too overconfident in its forecasting. But from what you're saying, it sounds like this is down to a material downturn in trading by and large.
Yeah, and I think there's been, as you said, the 7 consecutive quarters. So we've seen this at the back end of last year and coming into this year. And like what the data's showing is that it's spreading across the economy. So smaller companies have been impacted previously, but as I said, it's moving now more towards the mid-market. And so, we do anticipate that because of this, we will see that increase in restructuring activity, which traditionally comes after the peak in early sort of downgrades.
And what about individual sectors? I mean, I would imagine that construction and property will be among the highlights here.
Yeah, I mean, it's been a broad range of sectors impacted, from real estate to renewables. But I think, as you say, the most vulnerable in this particular quarter is those within the UK housing value chain, from contractors to estate agents. And so I think, that whole bit around have been at a 3-year high, citing slower house building. And it's particularly, that particular sector. But what I would say is that it's coming again from those smaller mid-sized contractors. Larger construction firms have been largely protected for now. And that's mainly because of the diverse portfolio. The other area that we're starting to see is within the industrial sector. So where we're seeing spending delays or cost cutting. So that business to business spend area as well. So less around the consumer side this time, but more business to business spend.
Briefly, if you would please, Joe, thinking back to the financial crisis, we obviously saw a lot of equity fundraisings around that time. It seemed like there was one every day at one point. Are you expecting something similar this time around?
Look, I think, over the last 12 months, we're starting to see, the impact that we've had. And whilst there are parallels to 2008, I think that was around a single economic event that caused that. What we're seeing now is the result of a prolonged, sustained period of pressure felt by businesses. So I think, in this build-up, there are things that, UK-listed companies and broader can do now to actually try to counteract that and think about what do they need to do to build that resilience for the future.
OK, Joe, got to leave it there. Appreciate you joining me today. Thank you.
Thank you. All right, thank you.
That's it from me. I'm back at 4:30 with our afternoon edition. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Jane Secker. See you later on. Cheerio.